Today's quick video in this series is going to introduce us to basic sales accounting. All business starts with sales, and recording those sales transactions properly is known as sales accounting. We're going to explore a few elements of sales accounting that entrepreneurs need to know in order to be able to make sure you record your sales properly, minimize your taxes, and maximize your profit. Businesses need to understand, first off, the importance of credit, both using credit to buy things as well as giving credit to potential customers. If you're selling products on credit, you need to keep track of what your customers owe, and you need to make sure that they pay it. The account that records what your customers owe is known as accounts receivable. So when you tell someone, you ship them some product and you say, hey, you can pay me in 30 days, you're going to record that as revenue on one side, and on the other side you're going to put accounts receivable for the amount that they owe you in 30 days. In 30 days, when they actually pay you, you're going to record cash in and accounts receivable goes down. So you exchange a cash asset with an accounts receivable asset. The management of that credit is critically important. Folks have a tendency to stretch out that credit if you're not on their case about making sure that they pay. On the other side, if you are selling products, you want to be able to get as long a set of credit terms as possible so that way you can sell whatever you've bought on credit, get the profit, and then pay the person who supplied you with those goods or services. And so that piece is going to be accounts receivable, or excuse me, accounts payable. And so when you go buy something on credit, you're going to record it in increase in inventory on one side, and then you're going to record accounts payable on the other. And when the cash goes out to pay the accounts payable, you're going to reduce your cash and you're going to reduce your accounts payable. Sometimes these things flow in the course of 30 days or 45 days, and they just kind of happen. However, every once in a while, like at the end of the year, they kind of slop over into another period. And so one of the challenges is, if I actually sell something to somebody, but I haven't gotten the cash yet, do I record that on my books as a sale? Or do I wait until I actually get paid for it in order to record it as a sale? And if I bought something over here, but I haven't paid for it yet, but I've got it, do I record that as having bought it and having a payable? Or do I not record it as having bought yet? And the rules around this from GAAP are extremely complex. But the simple answer is, if you're on a cash basis, you record the sale when the cash comes in and when the cash goes out. If you're on an accrual basis, you record the sale when the goods are shipped or delivered or when they're received. And the obligation to pay is created on either side. And these things can slop over a fiscal year or the end of the year, and they impact your taxes. Because obviously, if you haven't gotten the cash yet, but you've recorded it as a sale, you're going to have profit on that potentially and have to pay taxes on it, but you don't have the cash. And the same thing, you may have you may have expenses. You haven't sent the cash out yet, but you can deduct them for tax purposes if you haven't paid the cash, if you're on an accrual basis. If you're on a cash basis for tax, it's pretty easy. If the cash hasn't gone or the cash hasn't come in, it doesn't go on to taxes yet. And so that's part of the basic sales accounting, is just kind of, when do I record the profit and loss or the revenue and expense for the purposes of tax. And most small businesses, as we've discussed earlier in these videos, are on a cash basis up until they're at $1 million or so in sales, and then a lot of them will flip to accrual basis. And I generally recommend that you use an accounting system like QuickBooks that can show you both, because you may want to stay on cash for tax longer. they will allow you up to a certain size to have accrual basis for reporting and cash basis for tax, which gives you the best of both worlds. It shows you kind of the best picture, probably most accurate picture from an accounting perspective of how the company's doing on an accrual basis. And then for tax purposes, you report it on a cash basis. So you don't record those sales until the cash actually shows up. You don't record the expenses until you actually pay them. And as a result, you're paying taxes on the cash you actually have made, profit or loss. So it's a fairly good rule, and depending on the type of business you are, that can run up to $5 million or more before you have to flip to accrual basis for tax. An accountant is going to record the sales revenue and cost of goods sold, and we talked a little bit about cost of goods sold earlier in this series, for the sales in the year in which they're made. That's the accrual basis accounting, which means it'll be the accountant records revenue from your sale as soon as you make them, even if they haven't delivered those products to the customers. The accountant should also record expenses incurred during that time period too, and record them in accrual basis. Again, if you've got a decent system like QuickBooks, that handles all this stuff for you. You put the data in and you record it and you enter the payable or the receivable. When the cash comes in, you apply the cash to that receivable, and when you pay the bill, you assign that to the particular accounts payable, and it will do the accrual and cash basis for you. If you don't use QuickBooks, you do this manually, you do it in Excel, that's your difference, is the obligation of when you're obligated to pay or obligated to get the money versus when you actually get the money. That's your difference between cash and accrual basis. When a customer uses a credit card, what happens then? Well, a credit card is a short-term accounts receivable. Generally, the customer's going to come in, or they're going to record online, they're going to enter their credit card information. It's going to authorize the card, it's going to approve the transaction, and you're going to ship the goods or you're going to provide the service. You don't get that actual money for 3 or 4 days. Sometimes even a little bit longer, depending on who your clearing bank is. And so as a result, you actually have this really short-term accounts receivable from the bank or from the credit card company to come in. And again, that's treated like any other accounts receivable. The bank owes you that money. The credit card company or your credit card processor owes you that money. That's an accounts receivable, and it kind of comes flowing in later. Same thing, you pay with your credit card. You now have that obligation to pay, and so it becomes a loan, but you don't actually pay it for several days to 30 days. So that's one of the ways you can kind of stretch out your payables, is you may have a vendor who says, okay, you need to pay me in net 30. So you go, which means 30 days after I ship you the goods. So you do a net 30, and then you pay that bill by credit card. Now you've got another 28 days or 30 days before you have to pay the credit card. So you've now made your payables 60 days. And on the other side, if you're taking credit card, well, as we've talked about, they'll take a little bit of a cut to process that. You're getting your cash within 3 to 4 days. So you're able to accelerate your cash flow on the front side, delay your cash flow on the back side, and that's going to help the cash flow health of your business. But if you charge something on a credit card, that becomes an accounts payable to you. You owe that money. As soon as you charge it, you've created that obligation to pay, and then the cash will go out later. One of the big expenses associated with a business is cost of goods sold, and that's whether it's products or services. This cost of goods sold concept is one that is sometimes difficult to get your head around. It's easier if you're in shipping product. It's harder if you're providing services. But let me describe it this way, and we touched on it in the last video. If you have inventory, so you have a store, and that store sells tomatoes, and all you've got is tomatoes, and you buy tomatoes, and you have $1,000 worth of tomatoes, and you sell those for $1,500. You get $1,500 cash. You paid $1,000 for those tomatoes. That's your cost of goods sold. You take your $1,500 that you collected in cash minus the $1,000 cost of goods sold that you paid for the tomatoes. Your gross profit is $500. The cost of goods sold is the amount that you pay for the direct service or direct good that's being provided to your customer. And the amount of revenue, so the money that's coming in minus your cost of goods sold, gets you to your gross profit, which is the amount of money that's available for profit and overhead once the direct costs of selling that particular good or providing that particular service is paid. So for instance, if you're an accounting firm, you may have, billings of $300,000. You have your accounting staff and you paid the accounting staff $200,000. That goes into cost of goods sold, cost of services provided, $200,000. You paid your accounting staff, your CPAs on staff, $200,000, which leaves you $100,000 of gross profit. $300,000 of billings minus $200,000 of wages gets me to $100,000 of gross profit. And from that comes your rent, your insurance, your secretarial support, your software, your depreciation, etc. And you can get to a level of detail, and a lot of manufacturing companies do, where they allocate some of that overhead up into inventory and cost of goods sold as well. Most companies do not. They just go, okay, here's my direct cost of providing that service, direct cost of those products, and then I've got a gross profit, and then I offset that against overhead. It's important to understand your profit margin, because if you're not making money at the gross profit line, you certainly can't make a profit anywhere else in the business. Your goal is to have the highest gross profit you can and then minimize your overhead to leave as much in the bottom of the bucket as possible, which is what you get to keep as the owner to either expand the business or to live on. And that becomes the kind of fundamental pieces of sales accounting, is focusing on what's my gross revenue? When do I get to recognize revenue? So when do I get to actually book the sale? How much did it cost me to provide that sale? And when did I pay that? And then what's my gross profit? What is the amount of money that's going to come to me in the form of profit and to cover the overhead of my business? And again, one of the secrets to successful small business ownership, the successful entrepreneurship, is to minimize that overhead, to drive that overhead as close to zero as you can and still run a good, viable business. You want to maximize your gross profit line, you want to minimize your overhead line, you want to maximize that bottom line. You do that, and it's going to provide you with the financial freedom that you're looking for. But it starts with understanding, what's my revenue? When do I get to book my sale? And how much did it cost me to provide that sale? Am I on a cash basis, in which case the cash needs to line up, or am I on an accrual basis? And this is where cash and accrual become critically important, because if you're on an accrual basis, you're going to record those, the cost of goods sold. You're going to record that cost of goods sold at the time the sale is made. You're going to record that revenue at the time the sale is made. And so as a result, they match up really nice, and you're going to be able to get a good picture of that gross profit, which is why, again, you're going to hear me say, use a good accounting system. And for small businesses, I tend to recommend QuickBooks. For larger businesses, you've got a lot of choices. You've got your NetSuites and your Microsoft Dynamics and other things. But for small business, I tend to like QuickBooks. Most people know it. Most people use it. A lot of resources out there. You're going to want to maintain that. Look at that gross profit line. If you're on a cash basis and you've delayed payment on your cost of goods sold, and you've got accelerated payment on your receivables, you might get a mixed message on your gross profit line. You might have a very high gross profit line, then down the road, if sales drop off, but then the bills come due over here for the delayed payables, and you're on a cash basis and you're reporting those out in a later period, that becomes more difficult to manage. So again, I'm going to strongly recommend you go with an accrual basis for sales accounting, so that you can time up and match your revenue, your expenses, and your gross profit. Gross profit needs to be healthy. If you have an unhealthy gross profit line, the rest of your business is going to be unhealthy. If you have a very healthy gross profit line, then you manage your overhead, and if you can manage your overhead, the rest of it goes in your pocket, and that becomes your vehicle to financial independence. Until next time.